Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it is always a pleasure for me to see such a great crowd and energy in the room for our semi-annual Global Economic Prospects. As many of you know, both online and in person, we have been doing this for quite a while now, and we think it has become a relatively fixed point on people's calendar, and we're glad of that. We think it makes an important contribution to the public discussion, currently led by our non-resident senior fellow and professor of the practice at Harvard, Karen Dynan, who I will introduce more in a moment. Usually in this slot, I spend a lot of time reminding people of all the out-of-consensus calls that we got right over recent years. I will not do that today, although you should look back at the one from 6 months ago where I did list some of those. What I will say is we think this is a particularly interesting and important time to be looking at the macroeconomic outlook for the world's major economies, which is, of course, our purpose. And we consciously do it every year, roughly a week ahead of when the IMF releases the World Economic Outlook in the spring and the fall. The idea being, even with all our IMF alumni and friends, that we are not their huge forecasting staff. We do not have every country and every model, but that we do have people with in-depth expertise in the major economies, as well as under Karen's leadership, with contributions from Jason Furman, Dave Stockton, who used to run this for us, a little bit of kibitzing from me usually, although not as much this time. We like to think we can make a positive contribution by identifying places where either we see things from a political economy or a data interpretation point of view that are out of consensus, or where we are free to point to things affecting the forecast that the official sector is understandably constrained from doing quite as frankly as we do. And so that combination, I think, is part, along with the great analysis my colleagues do, to give you the sense of what's going on. I said, however, it's particularly interesting to talk about the global forecast right now, I think, for three reasons. First, obviously, the US forecast has become, I think, more uncertain in a genuine way in recent weeks and months. Karen, I will not in any way preempt Karen's presentation, as just to say that she is as aware as anyone of the run of relatively disappointing data and strange data, frankly, we've seen released in the US over the last several weeks. Forecasting is always a bit of an art, but this is making it a little bit more artful. And we hope to have your engagement and discussion as we try to make sense of this. The second reason I think it's crucially important that we discuss the forecast even more than usual is because of the fundamental concerns, which many of us share, that we are in a low R-star world, that we are in a low trend growth world, that the central banks are obviously stopping their hiking cycles well short of ammo to cut rates in the next recession. And therefore, I am particularly glad to have Joseph Gagnon, our colleague who has been a senior fellow here since 2009. Wow, it's 10 years now. Time flies when you're having fun. Joe, as many of you know, was a very senior staff member at the Federal Reserve Board, both in international finance for most of his career, and then ultimately one of the architects for Ben Bernanke and the FOMC of QE1 that has done great work on monetary policy since then. So Joe will be taking us through his and Chris Condon's new working paper, which is available on the website and available today, on the Phillips curve in the US and applying that to how to understand the monetary policy situation the Fed faces. And then the third reason we need to think, I think, particularly hard about the forecast at this juncture is because this is looking like a very different set of circumstances than we faced in 2008. God willing, it is a far more propitious, less dangerous set of circumstances. But key to making that assessment is what we think is the financial fragility of China and what we think is the possibility for stimulus in China, because we may have taken for granted, or for that matter, even complained about China's ability to be an ongoing engine of growth in the last several years. And now the question is, how much of a Chinese slowdown are we having? I'm sure all of you watched and read Nick Lardy's fabulous book, The State Strikes Back, in which he made a case about the medium to long-term growth sustainability. Today, we are thrilled to have Martin Chorzempa, frankly, our young rising star here at the Institute, to present on Chinese financial fragility, stimulus options, and the outlook from that perspective. Martin has previously studied in both Germany and Beijing and worked on financial liberalization, including as a Luce Scholar, Peking University's China Center for Economic Research, and I know he has co-authored and worked with the people at the People's Bank. Many of you have read his recent works on fintech, but also on global investment issues, and we are thrilled to have Martin making his Global Economic Prospects debut today. So let me now turn it over to Karen Dynan, the former Assistant Secretary for Economic Policy of the US Treasury, our leader in matters forecasting. Karen.
Thanks, Adam, and good afternoon, everyone. My clicker isn't working. What am I doing?
That's the remote.
No, I was trying this one. Oh, it's not on. It's not on. All right, technology. Okay, so this slide shows my global forecast. As you can see in the top line, a major theme in my global forecast is that we're going to see a downshift in economic activity this year relative to last year. So I'm forecasting that the United States is heading rapidly back to trend growth. Same goes for the euro area. I actually think the recent data has been a little. It's a bit of a soft patch. I think it kind of overstates the loss of momentum. So I do think we'll see a little bit of pickup next year. And then the other major economy that I'm forecasting to slow is China. And as Martin's going to explain further, that is a result in part of the government's successful efforts to curb credit growth there. I am not forecasting that every economy is going to decelerate. So in particular, I think Japan's growth is going to hold up at a rate that's decent for Japan. And that we'll continue to see brisk growth in India, and that the recoveries in Russia and Brazil will continue, albeit at a slower pace than we thought previously. And as for the UK, I'm putting down kind of modest to moderate growth. There's just a ton of uncertainty, as everyone probably recognizes, about what's going to happen with Brexit. Anyway, in terms of what's behind the global forecast, so yes, there are some special factors that are putting a damper on growth right now. So for example, there have been bottlenecks for German automakers that have to do with new emission standards put in place late last year. So there's some special factors weighing on growth, but really what I think is going on is just largely a return to trend growth after a couple of years of cyclical boom. So I think this is a story about what the new normal feels like. So this is occurring amid financial conditions that are tighter on net than in 2018, even if they are easier than they were a few months ago, and then waning fiscal stimulus in the United States. I will also note that my new forecast includes considerable downward revisions to where I was 6 months ago, and that's partly or largely based on incoming data that's just been weaker than we have expected for Europe, for China, for Brazil, and for the United States. That just suggests that the fundamentals are not supporting growth as that's as rapid as we thought. Turning to the United States, this chart gives you a sense of just how important we think the fiscal stimulus effects are. So what you can see is that we estimated that in 2018, both the tax bill and the spending bill from last spring boosted growth by about 3/4 percentage point. Whereas this year we think the boost is coming down to between 1/10 and 2/10, and then it's going to give way to a modest fiscal drag in 2020 and 2021. So on a Q4 over Q4 basis, I'm forecasting growth to decline from almost 3% in 2018 to a bit less than 2% this year, which is just a kind of hair above where I think potential output growth is, before falling a bit further to below potential next year. I expect the unemployment rate to bottom out this year at 3.7%, about where it is now, maybe a little lower, and that inflation will pick up just a bit this year to 2% before rising modestly next year to 2.2%. And I should say on the inflation front that PIIE forecasters have been wrong on the high side, for a while now, like forecasters many other places. And that's because we were misgauging the amount of slack in the economy, or at least to some extent it was because of that. And I think now there really is a stronger case that we are at a slack in the economy. One of the issues that keeps coming up, and Adam alluded to this, is what to make of this string of disappointing data that we've seen the last couple of months. And, as you can see in the graph on this chart, the concern is that we saw this really rapid growth in the middle of 2018 that then decelerated in Q3, but then decelerated quite notably in Q4. And for Q1, the various nowcasts are kind of, they're jumping around. But I'm at about 1 1/2 for Q1. There's a lot of uncertainty about that will get resolved as we see more data. So I don't think the slowing is really so mysterious. The slowing is consistent with estimates that fiscal effects on growth peaked in the middle of last year and have been coming off. So again, it's just a story of this is what the new normal feels like. For Q1, it's really not so weak because we think there were special factors, including the government's shutdown, including residual seasonality, that are holding back growth by a material amount, maybe 1/2 to 3/4 percentage point. I mean, this is not to mention, the effects of slower tax refunds and maybe some weather effects. So we think those effects are really in there. And I expect that we'll see a rebound in growth in Q2 to something that's more like what we saw in Q4. What's been going on with consumption actually has been particularly eye-catching, I think. The graph here shows you that retail sales released yesterday for February. You can see this decided flattening in retail sales after an uptrend last year. And I will say these are nominal numbers and they're not total consumption. But if you look at real PCE through January, you see the same trend in there. So, a couple of comments on that. And one is that we do sometimes see these periods where we get a quarter or two of weak consumption growth. In fact, a year ago, we saw consumption growth that was quite lackluster. The second thing to keep in mind is that the fundamentals just look very good. And that's what I'm showing on the table on the right. They look very good relative to 10 years ago or 5 years ago. We've seen a bunch of income growth that has kept the personal saving rate high. The wealth-to-income ratio has risen. The Fed is now releasing some distributional data about wealth-to-income. And you can see it's not just people at the very top of the income distribution. It's really people in the top half of the income distribution. Debt service is at low levels. Delinquency rates in most areas have come down a bunch. So the fundamentals look good. You can't rule out an animal spirits story, of course, but there I would say indicators of household confidence do seem to be holding up. So if I were going to be telling a story about animal spirits, I would the first thing I would look for would be a plunge in auto sales. We're going to get data today that actually show March being kind of weaker than the last point on this chart. Sales will probably come down to something like 16 million units, but that's not a plunge in auto sales. And likewise, consumer sentiment has been holding up. Housing is another area where the data have been surprisingly blah. That's a technical word. So, in particular, if you look at housing starts, they're showing on the left here, given that mortgage rates are down 75 basis points from last fall, income growth is holding up, credit seems to be available, it is striking that we haven't seen more of a pickup in housing starts and that the level of housing starts remains, 1/3 below where it was 20 years ago. So what I think is going on here is that to kind of have higher housing starts, we need more household formation. And one issue here is just the millennials we are seeing some household formation, but I think the millennials are holding it back. What I'm showing in the graph on the right is a share of 25 to 34-year-olds, okay, so not college students, that are still living with their parents. And you can see that they've trended up and they've continued to trend up as the economy has gotten stronger. And so I think what this is telling us is there is a real affordability story there because house prices have risen so much. I think the millennials will overcome that. We're seeing some increase in homeownership rates, but I think they're going to cross that hurdle slowly. On the business side, 2018 was a good year. So I'm showing business fixed investment growth in the panel on the left. And what you can see is that, even outside of activity in oil and mining, which would have been boosted by the firming of oil prices, you can see an acceleration in business fixed investment. That's the light blue bars. But, the however there is that if you look at new orders, you can see there that kind of this uptrend that we saw in 2018 has given way to flatter new orders. Probably not too surprising given what we know is going on globally. And I would say maybe not so surprising in light of the fact that maybe there's some payback for the rapid growth we saw in the middle of last year. Okay. For net exports, I'm assuming the dollar will remain fairly strong given what's going on globally in terms of relative growth rates of countries, and that net exports will continue to be a modest drag on growth for the next couple of years. I do expect some deceleration in both imports and exports underlying that. Okay, so turning to the supply side, non-farm payrolls, which you can see on the left, they have continued to run faster than the pace that is suggested by demographics, considerably faster. I expect that with slower growth, we are finally going to see a moderation in non-farm payroll growth, and we're going to see it soon. In the next few months, we're going to see a significant moderation. We've been able to enjoy these robust payroll gains because without driving the unemployment rate further below the natural rate because, of course, we've seen this increase in prime age labor force participation, which is a welcome development. But there too, I think we are kind of getting close to the limit of what can happen there given kind of the secular downtrend over time, and I don't expect that trend to continue much further. So together, these developments give us this flattish unemployment rate that I told you about before. A related consequence of recent labor force or labor market developments is that we've seen wages accelerating. That's what you can see on the left in the slide. I would characterize that as also a welcome trend. I think it's strengthening our consumer base. I think it's good for people more broadly. I don't think it's going to push up price inflation necessarily. That's partly because I believe Joe's models, which Joe will be talking about in a few minutes. But I'll also note, if you look at the profit share, it just remains very high. So it's suggesting that we have room for wages to grow without putting pressure on profits. Okay, so Joe is going to talk more about inflation dynamics in a moment, but as I noted earlier, I expect that we're going to see a very modest overshooting of the Fed's inflation target over the next couple of years for both headline and core PCE inflation. I don't think it's anything that's going to worry anyone. As a result, I have taken out all of the Fed tightenings that I had in the forecast this year. I left just one tightening in next year, and I suppose we could probably argue about whether that's going to even occur. I do think that we're going to see more of an increase in long-term interest rates, because I do think that long-term interest rates have overreacted to recent data. So I am looking for a larger increase in long-term interest rates. Okay, so of course there are risks to the forecast. I still see them tilted to the downside, but I think that the mix is different than what I would have said 6 months ago. I don't think it's that likely that we're going to see inflation take off in a way that results in the Fed moving more sharply than is currently anticipated towards higher rates, which is of course something that has set off recessions in the past. In terms of what I think is more likely, it's not huge for the US economy, but I have to say I'm coming around to the Adam Posen camp that hard Brexit is more likely than a lot of people seem to think it is. I will also say that given data disappointments in recent months, I think we need to be concerned that trend growth is just weaker than we've been thinking it is. And I would say, yes, it is true that productivity growth has picked up a bit. It picked up a bit last year, but remember that pickup comes after a number of years of very weak productivity growth. And really, when we look to think about productivity trends, we tend to take averages over more than one year. And then I would say, relatedly, I think we need to be concerned about political dynamics that reinforce the slow growth. And in particular, I just think that, the new normal is just not going to feel that great relative to history. And I think that just increases the odds that we'll see political developments that lead to kind of more resistance to needed positive structural reforms and more support for populist policies like protectionism. Okay, so that's all I have to say. I'm going to leave it there, and I'm going to turn things over to Joe Gagnon.
Thank you. I will focus on the outlook for inflation in the United States and what that means for monetary policy. Let's see if I can get this thing to work. So to start out with, as Karen mentioned, unemployment in the United States, shown in the top panel, is very low and is projected to remain low into next year, and that's also pretty consistent with what Karen had. And this is lower than most estimates of what the natural equilibrium rate is, which are shown in the bottom panel. It's not a huge difference, but it's noticeable and projected to last for a while. So normally, we think that when unemployment is very low, that this will put upward pressure on inflation. But what we see from two forecasts here is there really isn't any in the forecast. Both of the Federal Reserve's FOMC, Federal Market Committee forecast of core PCE inflation in the middle panel. That's PCE inflation is what they target, and core just removes some of the volatile food and energy prices. That's flat at 2. And the blue chip has a survey of private forecasters, and this is for the overall CPI inflation, and that's flat at 2.2. CPI tends to run about a quarter of a point higher, but they're both very flat. So you don't see any effect of unemployment on these inflation rates. But we normally used to think of inflation as responding to unemployment, and that was a relationship we called the Phillips curve. And so I've drawn here a typical Phillips curve that relates the change in inflation to where the unemployment gap is. So the unemployment gap is the unemployment rate minus the natural rate. So it's negative when unemployment is low, and it's positive when unemployment is high. And as you can see, when unemployment is low, that tends to put upward pressure on inflation, as shown by the line on the left of the panel. But a number of researchers have found that in the past 20 or so, 20, 25 years, if you estimate a Phillips curve, you get a much flatter curve, and something like this. And in that case, you can see even a 2% unemployment gap, plus or minus, has very little effect on inflation. And that can support the kind of flat forecast that you saw when I started. But what I have just been working on with my colleague Chris Collins, and it's a paper that was made available to you at the door. You're welcome to take it home with you. We propose an alternative, which is that perhaps when inflation is very low, the Phillips curve actually is bent or kinked in something like this. So when unemployment is high, there's not much effect on inflation, as other people have found. But when unemployment is low, there might begin to be some effect, and perhaps that would mean more upward pressure on inflation than most people are forecasting. So why should the curve be kinked like that? Well, the main reason is downward wage and price rigidity. Even in good times, there's always some firms that are doing worse than average. They have weak sales, and they would like to raise their prices and wages less than others. And of course, other firms may be doing well, and they want to raise more. So average inflation, which is the average over all these higher and lower price increases, is what we call inflation. And if average inflation gets close to 0, then some firms, the ones who are getting bad news, are going to have to cut their wages and prices, and they may resist. And they may actually accept a loss of sales or layoffs of workers rather than cut their wages and prices. And this downward rigidity tends to bend the Phillips curve when inflation's low. We, in the paper, we show a little theory model to explain how that works, and it leads to something like this. When average inflation is high, around 10%, you get the upper line there, the green line, and it's this traditional Phillips curve. It's relatively linear, downward sloping, as we saw before. But as average inflation falls, more and more people are squashed by this desire not to have outright wage cuts or price cuts. And that bends the Phillips curve, and it bends it particularly more on the right than the left. On the left, the declines are relatively parallel and linear, but on the right, the curve bends and becomes flatter. So in our paper, we find evidence that two different versions of the Phillips curve can explain the data over the past 60 years roughly equally well. And when we have high inflation, they both yield similar results, which is the panel on the left. You get a standard Phillips curve sloping downward. But when there's low inflation, then we either have what we call the shifting linear model, which is a dashed red line, and that's a very flat curve, which leads to the forecast you saw of almost no effect on inflation. And the alternative we want to put forward is we call the low inflation bend model, or I'll just say the bend model, where it has more of a slope on the left side than on the right side, as I just mentioned. And why is it that we can't tell which one fits the data better? Well, the answer is that since about 1995, 95% of the time, the unemployment gap has been greater than -1. In other words, we're always either around 0 or above 0. We haven't been below 0 to any significant extent. And so you really can't distinguish in the data which curve is right. But we think logically there are arguments, and based on history in the past when we had low inflation back in the 50s, there's some evidence that maybe if you go back far enough, there might be upward slope. Now, the Phillips curve isn't the whole story, and bear with me, this is the only equation you'll have to work through, but so what I have here is sort of how we think of inflation. Delta P on the left is the change of prices, which is inflation. The gap is the unemployment gap I'm talking about. That's the Phillips curve. Then there could be a constant added plus. The important thing is, what does lagged inflation do? Is inflation building on itself? And there's really two extremes to consider. One is we call the accelerationist model, where beta is 1. In other words, inflation is whatever it was last time plus some effect of the Phillips curve. In that case, the Phillips curve describes the change in inflation. It builds up over time. The other version is the anchored model, in which case beta is 0, in which case inflation always returns to a fixed level. And Phillips curve describes the level of inflation. And what we show in the paper is that inflation's dynamics, that sort of the response to past inflation, has changed over time. Before 1967, it was relatively anchored. Then in the 70s and 80s, it became unanchored. And then starting in the late 90s, it seems to have become more anchored again. And in fact, it may be that inflation's been anchored a little bit too low. As you can see here, these are two versions of the Fed's preferred measure of inflation, PCE inflation. The core measure in blue excludes food and energy prices. It's less volatile. It's clearly, it has been below the Fed's target of 2, which is the red line up there. And it's actually averaged 1.7 since 1995. The green dashed line is the overall measure, which is more volatile, but it also has been below, on average, 1.8. So it's possible that people actually have anchored at too low a level. I'll come back to that when we talk about monetary policy. But I now want to just say, what difference does this make for the forecast? Well, we in the paper show forecasts for wage inflation on the left, this employment cost index, or a core CPI inflation on the right. And we use the two models, either the shifting linear model or the low inflation bend model, to forecast inflation. And what you see focusing on the right is that if unemployment stays where it is now over the next few years, the shifting linear model has very little increase in inflation. It levels out at around 2 and 2.4 for the CPI. But if you think there's a bit of a kink to the curve, then it goes up more to 2.7. Not a huge difference. And the thing is that it levels out because we assume that expectations never rise over time. Now, if, in fact, inflation were to go up in a sustained way, it's possible that expectations would adjust and would shift, and then you might get something like this. Note the scales are changed now. We have the possibility that if inflation went back to the more accelerationist world, where it builds on itself as expectations become unanchored, you'd get much more increase in inflation under both models, but especially more under the low inflation bend model. And I think probably the first chart is more reasonable in the very near term, but the second chart may be more reasonable in the longer term if we in fact kept unemployment this low. So finally, to turn to what this means for US monetary policy. Well, in his press conference last month, Fed Chair Jerome Powell expressed doubt that the public really has anchored its expectations fully up at 2% for the Fed's target. And I actually think that these doubts are the main reason why the Fed has unexpectedly paused in its hiking cycle. They're very concerned. They don't want to cause another undershoot. They recognize that they've been undershooting for too long now and that people are starting to doubt their word. They actually might welcome, although they aren't ready to say this yet, they might welcome an overshoot, if anything. Also, they're very worried about the next recession, which could come. We don't know exactly when, but will come at some point in the next few years, most likely. Will they be able to fight that recession? Well, they only have interest rates at 2.5%. They can't go much below 0. So that puts a limit on what they can do with ordinary policy. They can do quantitative easing or QE, which will certainly help, and I think they will do it. But they worry how much scope there is for QE, and they're worried that they might be stuck in a position where they can't do as much as they would like, and the unemployment would remain too high, and inflation would be below target. So what they're doing this year is a major review of their strategy, and I think it's motivated by that fear. And I think where they're headed is sort of previewed by a very recent paper by former chair Ben Bernanke and also Michael Kiley and John Roberts, who are senior researchers here in Washington at the Federal Reserve Board. They argue that monetary policy will achieve its goals better over time in the long run if it intentionally aims to overshoot the inflation target after a period of undershooting at the zero bound. Okay, and this is a way of keeping inflation expectations in the future up. What matters, how monetary policy affects the economy, is the difference between the nominal interest rate and expected inflation. That's called the real interest rate by economists. And you can lower the real rate more if you can raise expected future inflation. The Fed wants to do that to some extent through this possible change in policy that Bernanke, Kiley, and Roberts recommend. I think if the Fed does end up announcing something like this around the beginning of next year, and if, as Karen and I think, next year it starts to become apparent that inflation might overshoot the target a little bit, I think the Fed would welcome that. It's actually good that the Fed should adopt this new policy now and get it sort of in people's minds before the next recession hits. Because if you wait until the recession and you're undershooting your target, it may be hard to persuade people of what you're aiming to do. So finally, to turn back to where we started with these very flat inflation forecasts, I think Karen and I both think that it's likely that inflation will go a little bit higher. I would say by 2020, we might see PCE at 2.25 and CPI at 2.5. And if unemployment continued to be this low, it could even rise a bit more in 2021. But I think a modest overshooting of that magnitude actually, I think would be, well, now from the current perspective would be seen as an error, but I think under the new framework it might not be, it would be welcomed, and I think it should be. Thank you.
So thank you, Adam and Karen, for having me to go more in depth on the China forecast, which is slower growth, but as Feng Xinghai, one of China's high-level policymakers, said at Davos, not a disaster. GDP growth, we're looking at the lower end of the Chinese government's plan for the coming year, which they said could come in anywhere between 6 and 6.5%. We should congratulate Chinese policymakers for their extraordinary success over the past years in restraining credit growth, bringing it more in line with nominal GDP growth, and also restraining shadow banking, which has massively reduced financial risks and we think lowered the probability of some events of financial instability in China. The challenge this year then shifts to something that's much more difficult, which is restoring credit to the private sector, which has suffered in the shadow banking crackdown. I'll go more in depth in that later. And I believe there's limited prospects for large-scale monetary and credit stimulus because of the challenges that they've been dealing with as a result of the previous sets of monetary and credit stimulus, which has taken years to clean up and has lowered medium-term growth possibilities. So that leads to expectation on the lower end of the government target. We'll begin with the successes, which is slower credit growth and a shift away from shadow banking. This chart is the bank lending to non-bank financial institutions in China, the year-on-year growth rate. You can see this is actually one of the main channels through which money flows from the banking sector to the shadow banking sector. In early 2016, this was growing at about 80% a year, which is quite extraordinary. And what's then extraordinary about what's happened since then is that the Chinese government has managed to pull it down, not only to grow in line with nominal GDP growth, but also now negative 10% year on year, which is incredible. many would not have predicted that a few years ago, that they were this serious about reducing financial risk. Here's another chart looking at the composition of credit creation in China from the central bank. The gray lines represent the parts of shadow banking that are captured in the central bank's credit numbers. And it's a little bit difficult to see, but in the previous years, this was a large share of credit growth, and it was always positive. But what's happened over 2018 is that it's been consistently negative. So shadow banking has been shifting, and the composition of credit in China has moved towards more regulated channels. And that's a positive for their economy. There's a lot of people made a big deal about this January spike in both shadow banking and credit growth, and we'll go a bit into the disagreements that caused in China. Now the shift that needs to occur is more credit to the private sector and small companies. State-owned companies are growing quite easily on easy credit. They grew about 8% last year in assets and had no trouble getting financing for that. But the private companies have suffered a lot more. China has this wonderful statement they call the two unswervinglies. One of them is that they will not swerve from bigger, better state companies. The other is they will not swerve from supporting the private sector. But of course, when these end up coming in conflict, one of them ends up more unswervingly than the other. It's difficult for China to end what I call one country, two financial systems. And in many ways, China has two. One of these financial systems is the system for connected, mainly state companies, which have easy access to credit, but it's also true for some of the larger private firms that have a great deal of collateral. The other financial system is either more informal or more based on shadow banking, and that's what ends up providing credit for the smaller companies and the private sector. This is the one that has been suffering in the shadow banking campaign. It's mostly hit these small private firms. Just give one example, the peer-to-peer lending collapse has taken out about 500 billion renminbi away in credit provision to the kind of companies that P2P lenders ended up lending to. And the problem is that the banks have not picked up the slack. This would not be an issue if some of these shadow banking borrowers were now borrowing from banks through regulated channels, but in fact, the banks are not doing this. The private sector was only about a third of bank loans in 2016. We don't really have good up-to-date information on this, unfortunately. The data comes out with quite a lag. The government has set a growth target. This top is Guo Shuqing, the head of the banking regulator, and the bottom is Premier Li. They've set a target of 30% increase in micro and small enterprise lending. But I'm quite skeptical that they're actually going to reach this, which is going to cause some issues. One of the reasons I think they're unlikely to do so is that the big five state banks, which are the ones with the most stable funding and the cheapest funding, have actually reduced their micro and small enterprise lending the last year, even though the government was saying we should unswervingly support the private sector. And overall growth in lending to the smaller businesses is down it was up only 9% last year, down significantly from the previous. That means there's a lot of inertia moving away from giving credit to the private sector that they'll have to overcome to do so. And also, there's a bit of a contradictory remit. We've been telling the banks for years that they need to reduce their risk. And one of the ways that you don't reduce your risk is by lending to small companies with unreliable financial statements and no collateral. But that's exactly what they're being asked to do. This is contradictory, so it's going to take a very strong political push for them to actually begin to lend in this area. Now, prospects for stimulus, highly awaited. There's been rising tension in the policy apparatus in China, which is quite unusual and suggests that there's far more discord and disagreement about the degree to which the economy should be stimulated than in the past. Middle of last year, the central bank and the Ministry of Finance had a public disagreement. The PBOC, the central bank, said that the fiscal policy was not being remotely supportive enough of the economy, and that forced the PBOC to do something very difficult. It had to support economic growth through monetary policy and at the same time try to reduce financial risk through administrative measures, essentially working at cross purposes with itself. The PBOC ended up winning this battle, thankfully. Then in February 2019, Li Keqiang, the premier and also nominally the boss of the central bank, took a look at those January credit numbers and said, we do not want to open up the credit taps and have this flood-style stimulus, and we're worried about the shadow banking component of that, which went back into the positive side. And if you look back at that chart I had, the next month has a negative component of shadow banking, which is approximately equal to the previous one. So the central bank, although it pushed back a little bit at the beginning, said, all right, we're going to restrain this. There are fewer levers available in credit stimulus than in the past. And the reason for that is that there are issues with the monetary policy transmission mechanism. There is a recognition among Chinese policymakers that, in fact, if they open up the taps of credit and flood the economy with money, it's not going to go into the places that actually lead to higher productivity and contribute to medium-term growth. Instead, it's going to go into the real estate sector, a lot of speculation, probably to state companies, and also to local governments. So what they're trying to do now is shift the composition of credit rather than ultimately deleveraging because of their success. I think they're probably about where they want to be on deleveraging. But because of the difficulties in getting the banks to lend to the private sector, I think they might loosen a bit on the shadow banking regulation going forward, because those are the best ways to get credit to the private sector. The fiscal stimulus has gotten a lot of attention. It's around 2 trillion renminbi in tax cuts, but I suspect it will be more limited than some think in its effects. The government deficit is now rising to 4.3% of GDP. The official number that they gave was 2.8, but actually that includes some accounting gimmickry, moving money out of some stabilization funds. The real number is more like 4.3. But these tax cuts are going to be mitigated by the fact that local governments are heavily squeezed on the revenue side. Many of them are projecting either no revenue growth or negative revenue growth for the coming year. And if you tell them cut taxes and you don't give them a way to fill that hole in their budget, then they're going to be reaching out for the piggy banks of companies in their jurisdictions and finding other ways to raise funds. So the outlook for the coming two years, one positive potential upside is that a trade resolution with the United States could boost sentiment and trade, but you'll notice that I didn't really talk too much about the trade tensions so far because I don't think that's what's driving the slowdown. I think it's more domestic factors in China. I expect some loosening on shadow banking, which could help alleviate the private sector side, but I don't anticipate it being excessive, opening up the taps. It's going to be more of a data-dependent, careful calibration, trying to make sure that they don't loosen up too much. Then medium-term challenges, there are quite a few. One is that they have begun to talk more about sustaining employment, and that, to me, reduces the probability of some of these difficult state-owned enterprise reforms, which would be necessary to get rid of some of the slack and some of the unproductive state companies that are bloated and have lots of workers that probably should find other work. The second is that we need to find some way for China to solve this local government imbalance. Chinese local governments have some of the highest share of expenditure requirements and some of the lowest shares of revenue in the world. That creates a lot of problems and distortions in the economy. One way to do that, to resolve this problem, would be to focus on a property tax, a recurring property tax, but they've tried this for years and the political economy has proven a little too difficult. And finally, even if there is a trade agreement with the United States, I think that this competition on the technological side, on looking at national security, is going to continue to exist, and that is going to manifest itself in more and more strict investment restrictions on Chinese entities, both in the United States and now looks like spreading to other countries in the world. And in the United States case, export controls, which might make it more difficult for China to get its hands on some technologies that it might need to develop in the future. Thank you.
Thank you, Martin, Karen, and Joe. If I can ask all of you to come up for on-the-record questions and discussions. And I want to take this moment to give an additional thank you to Christopher Collins, Joe's co-author on the new working paper, which really is a terrific piece of work in bringing together what a lot of people have been intuiting about the Phillips curve, but doing it in a very real data and theory grounded way. I commend you to download the working paper from our website. As usual, we are open for questions and discussion. Please raise your hand. There is a standing mic in back. Jessica is holding the traveling mic up front. If you're recognized for a question, please identify yourself before speaking, and please try to make it a question unless you're really fascinating. Who would like to go first? If you're brief, you don't have to be fascinating. Sure.
Jeremy Zettelmeyer, Peterson Institute for International Economics. So I have a question for Joe. Joe, when you showed your accelerationist picture with these diverging lines, the top one being your preferred model, my reaction was, this is the most hawkish I've seen from Joe Gagnon since I rejoined PIIE 3 years ago. But then you somehow kind of brought it back to a more conventional, at least in PIIE terms, conventional view, which is that some overshooting of the inflation target actually is a desirable thing. Could you do a bit more to reconcile these 2 points? So to reassure us that in light of your very convincing upward bending Phillips curve model, we are not actually heading down a route of inflation risk.
Sure. I think that upward sloping accelerationist line, if you want, is an extreme change in behavior that I don't believe would happen within a year or two. So I think that certainly over a reasonable forecast horizon, you really should focus on the first of those graphs because that's where people are now. But it just has to be there in the sense that we've seen this before. If the Fed were to just take its eye off the ball entirely and unemployment were to stay where it is or go lower, for 3 or 4 years, people would reevaluate. Are we right to have this view that inflation is going to go back to 2 when it clearly isn't? And we've seen that game before, and we know that people would adapt. And I think they would adapt faster now than they did in the 60s. So we could switch. But I do not think that's going to happen. I mostly wanted to show that chart to show that indeed these 2 models have very different implications over time if you let things go that way.
Great. Next question, please.
Bob Samuelson, Washington Post. This is for Karen. There seem to be 2 pictures of the economy. One is that it's weakening. The other, the stock market seems to be booming very strong. Can you discuss what your view is on that?
Sure. I mean, normally, so you're right. I'm forecasting this downshift in growth. Although I'm not forecasting a recession, what I'm forecasting is a shift back to trend growth after a very strong period. I think part of what we're seeing with the stock market is, so I think it's partly reflecting continued solid growth for the United States. I would say it's also, the thing that we can't really separate out is the kind of distinction between expected future revenues of these firms versus the fact they're going to be getting a larger share of those revenues because of changes in the tax code. So I think that is one thing that, if you look at what the stock market's done over the past couple of years, I think it's not entirely just bullish views about the US economy. All that said, I think the stock market seems a little more positive than I believe. I think they're viewing the prospects for the US economy as a little more positive than I think they are.
That's a nice, clear statement. Over here, please, and then there.
Hi, Joe Bleo from Brevin Howard. This is a question for, I guess, all the panelists. Joe, you intimated that perhaps the Federal Reserve would be considering some changes in its framework, going to something, call it average inflation targeting, call it what you will. I was just wondering what the panelists thought would be the implications for other central banks. Would they be forced to follow suit, or what dynamic do you think that would cause?
Okay.
I'll start and say, I hope so. When I look at, other countries, especially in Europe, but also Japan, it seems to me they're even more limited by the zero bound and limits to quantitative easing than we are. So I would think they should be worried and think about a change in their framework. Absolutely. I don't know if they will, but I think they should.
Karen or Martin?
Yeah, I wouldn't use the word forced, but I think, if it happens here and if it's successful, then I think that will be something that will bolster their will to do it.
Martin?
I don't necessarily think there will be a change in China. I mean, it's to a great extent very isolated from the U.S. and as good capital controls, good in the sense of quite effective recently in leaving it to be more independent of what the Fed is doing.
Joe, for what it's worth, can I add 2 cents? I think Joe articulated very well why at least some members of the FOMC are pushing the so-called average inflation targeting. I think there are some members of the FOMC, and whether or not they exist publicly, they should, who are understandably skeptical that this form of forward guidance will be about as ineffective as previous forms of forward guidance. And so you're doing this, in my view, as a desperation move or because it can't hurt. But what you really need to do is think in terms of more powerful tools ahead of the next recession and to get inflation up. That's for many of the same reasons as Joe. I just have a different view of the potential for this path. That being the case, I think the international side matters a great deal. As I said at our Rethinking Macro conference 2 years ago, by the way, the book is about to be out from MIT Press for that. Thank you, Olivier and Larry. When Bernanke first presented his conditional price level targeting proposal, I said, wouldn't it be much better if we had the major central banks agree on a raising of the inflation target? We all happen to be at 2. We all happen to be having ill effects from being at 2. In fact, ECB, Euro area, and Japan have worse ill effects than the US does. Wouldn't it be better and more credible and more effective if we could get an agreement that everybody went up at the same time to 3 or 3.5? Now, that of course caused horror, but I think another recession in which monetary policy is grasping the thin reed of this time we really mean it and future inflation will be higher is much too thin a reed. But that's just me. The lady there, please.
Hi, Jesse from Voice of America. My questions are for Martin. So I want to know your interpretation of the China's PMI in March. Some people say it's because the stimulus starts to work. I want to know, do you think it's sustainable, and what's your interpretation? And also about the US-China trade disputes, do you think it's not a major factor for China's economy? And how about the exports part? Thank you.
So I don't really look too much at PMI. I look more at the financial markets. There are some indications that there's been a bit of a rebound from some other private sector data sources, but PMI is a bit noisy, and there are some questions about that. Looking at the trade dispute and the net export side, definitely the export data from China has been much weaker than in the past, but it's hard to tell how much of that is actually a change in trend, because many of those exports were actually shifted to earlier periods, and that artificially inflated those numbers, and now they're lower. So we'll only know in a little while what the impact has been, but my sense is that they're not large enough yet to really shift a lot of the economic behavior. It'll have to be on for a while for firms to actually think about changing too much what they're doing.
I'm Bob Donor from the Atlantic Council. I hate to follow a China question with a China question, but this is for Martin. I'm going to push you out a little bit. What do you think China's potential growth is over the next few years? And the second part of it is that they've shown that they can control the flow of credit, at least over relatively short periods. Will they need to take real steps to lower the stock of outstanding credit?
So on the potential growth side, I think my colleague Nick Lardy has done more work on that than just about anybody. And the view there is that it's much higher than the current growth, that policy decisions that they're making to direct this credit to state-owned companies and to not undertake many of the reforms which would raise productivity in the economy have been dragging it down. And my sense is that I haven't seen any sense that they're going to move in a direction that actually raises any of that. And I'm skeptical about what they've said so far about shifting the credit. In the past, they've been pretty good at directing credit in some senses, which has been you can direct credit pretty easily to the property sector to boost that, to local government infrastructure and these things. But now they're being asked to direct credit in a different way than they have in the past, and that I think raises the difficulty compared to some of the previous episodes.
Great. Thank you. Nice, tight answer. Anyone else? Yes, please. The microphone's coming.
Hi, Caroline Atkinson on the board of the Peterson Institute. So thanks very much to all three of you. It's great. I wanted to ask a bit, looking further ahead and using the political economy. Karen, you said we're returning, the US, Europe, returning to trend growth. Martin thinks that it's even worse than that in China. But you also mentioned maybe the new normal is for lower trend growth, partly because of the political economy and trade issues. So how can we raise the trend growth or the new normal? Are there policies? Maybe it's Adams, and I always think of Olivier initially mentioning we should have higher inflation targets when he was at the IMF. Is it on monetary policy? Is it on fiscal policy, moving away from deficit hawkishness? Is it on measures to reduce inequality so that there isn't so much populist fervor against globalization? And what are the steps that can be taken that economists can recommend to deal with this lower trend, if that's what we all believe may be occurring? Thanks.
Thanks. Really important question. I mean, I will say, first of all, in terms of when I was saying new normal, I haven't changed my forecast for potential growth, which I still think is around 1.75%, but it's just not as high as potential growth has been in the past. And I think that's just not going to feel as good to us. But I will say, I expressed concern that maybe it is indeed lower than that. So I think it really does highlight the importance of really thinking about policies that will help promote growth over the longer run. And there I would say, well, so one starting point, of course, is don't do any more damage. And I think, so don't close borders, don't put in place more trade barriers. And I do think they're reducing income inequality, thinking of ways to promote growth that's more broadly shared, so that we're seeing more middle and lower income families seeing real income gains. I do think that is important, such that we can avoid these damaging political dynamics. Beyond that, I think we should be I don't think we should be too hawkish about the deficit given how low interest rates are now. And I think we should be focused on pro-growth investments. And I'm not just, public investments. I'm not just talking about infrastructures, and maybe more money into research, but I'm viewing investment in the broader sense. We know kind of education will pay off over the longer run. And by the way, that's a good choice, of course, because that would promote more broadly shared growth. But there's also this kind of new, interesting literature out there that's showing that more kind of policies that are more kind of social, we think of as social insurance policies, like food stamps or housing subsidies, that those not only help underserved people in the moment, but they're producing better outcomes down the road. You help children and they have higher earnings as an adult. And I think we should, as we think about investments, I think we need to take a broader view.
Joe or Martin, anything you wish to add?
I think Karen's point about investments, both in infrastructure and in human beings, that are the most important thing. I think in terms of monetary and fiscal policy, which you raised, I don't see there's a big scope for that per se right now, except if we do get into recession, we really need more powerful monetary and fiscal policy to prevent us from having a lost decade again. And that, we've seen that recessions have become potentially longer lasting because of the zero bound.
The way I see the political economy playing out in China of lower growth is that the margin for error on policymaking is getting tighter. And that's raising the need to have really good information about the impact that their policies are having on the ground. And some of the more recent announcements that have made it a little more difficult to discuss freely economic phenomena in China are potentially damaging for that going down the road. So I think they need to push a little more on having both good information so people feel they can speak up if a policy is not working very well, and that economists continue to have a robust debate about what policies are necessary, many of which now are going to be focused on both raising efficiency and cutting down some of the rents that have been given to some of the interest groups in the past.
Caroline and everyone, just to point out, we've had two recent events and sets of publications on this exact topic. We held an event for the release of the book on facing up to low productivity growth that Jeremy and I edited with Jeremy, Karen, and Anna Stansbury of Harvard Kennedy School the other day and talked about these issues. We also had an event on fiscal policy, taking off, starting with Olivier Blanchard's conditional statements about why debt may not be as scary as we think it was, but it's not unlimited, and comments from Jason Furman and Angel Ubide about, in the US and Euro area respectively, what could be pursued. So we view what you've pointed out as the critical macro issue going forward. And as I said at those events, I would just repeat, I think there are 3 points to be made as we, when you were on the G20 Sherpaing, there were already calls from central bankers saying, please do more with fiscal policy so we don't get into so much trouble. And Martin made reference to that becoming evident in text rather than subtext in China recently. So I think the first point is figuring out in some sustainable political economy way why politicians who are supposed to love to spend money seem unwilling to do public investment, and figuring out a way to do that. Second is defining some set of fiscal rules, and this is where we hope Olivier and others, and Jeremy and others will make a contribution. Defining some set of fiscal rules. Okay, we do have a slightly more space on the debt side now. How do we make use of it so it's not as wasted as the Tax Cuts and Jobs Act of 2017 or 18, whenever they got around to passing it. And then thirdly, I think, and this is just speaking for myself, I think we need to think in terms of genuine regime changing, crowding in on investment. We've been pushing on a string too long, but we need to think about aggressive things that force investment up. As Karen mentioned, it's not like investment has outperformed growth in this cycle. And that's why I find this dispute over the new Green New Deal and MMT as being quite unfortunate, because it ends up being a litmus test over who's lefty enough, instead of a broad range of economists agreeing that we should be doing something combined regulatory and spending and carbon tax to induce a very large amount of investment in green infrastructure. At the back, please.
Ted Truman from the Peterson Institute. So I'm going to pick up from your last comment, Adam, to Karen. I wonder, so you had a little bit in your presentation about business fixed investment, right? And to what extent do you feel that is, we often think about that as being somewhat more exogenous, if you want to put it that way, than consumer behavior and so forth and so on, or even net exports. And the question, I guess, is you have had this pickup, and you commented that it sort of has backed off. You don't know to what extent that is temporary. So the question I have is sort of, as you think about To what extent does your forecast that we're not going to dip below potential, let's put it that way, depend upon that business fixed investment would stay relatively strong and essentially not go into a negative phase of acceleration or deceleration in this case in terms of the overall forecast?
So my forecast is conditioned on growth in business fixed investment that is not as strong as last year, but is we're still seeing growth. And I think what we're seeing, I take your point that changes in business fixed investment can reflect animal spirits. I think what we're seeing now is a reaction to what's going on globally. And so I think you take that, you take the fact that the effects of the tax cut are positive, but pretty modest, we think. Maybe we're seeing a deceleration in part because it's payback for last year. So I think you put all those things together. And I would say yes, I'm incorporating an assumption that there is some payback from last year because I am assuming that the flatness that we've seen of late is going to pick up some. It's just not going to be as fast as next year. But yeah, if there was a collapse in business fixed investment, I'd have a different forecast.
Great. Well, please join me in thanking Martin Chorzempa, Joseph Gagnon, and especially Karen Dynan for leading us through this spring edition of the Peterson Institute Global Economic Prospects. Thank you.